Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at AusBiz as we get this session underway. But let's start with what we've seen on global equity markets. They came under pressure on Monday as oil prices rose and after longer dated US Treasuries had climbed to their highest level in more than a year. However, bond markets found support, which stemmed the losses among equities. Investors were also buoyed late in the session on Wall Street when President Trump posted he was holding off on a planned military attack on Iran scheduled for today as efforts continue to reach a deal there. The Nasdaq and the S&P 500 closing lower as investors took some profits in tech stocks. Nvidia, which is scheduled to report results Thursday morning our time, was the S&P's biggest drag, with Chief Executive Jensen Huang saying he expects Chinese authorities will eventually allow the import of its AI chips. Micron Technology slumped amid concerns that a labour dispute at Samsung could lead to a significant disruption for semiconductor supply chains. Intel shares rose after Citigroup said it expects the server CPU market to reach about $132 billion by 2030, with Intel in the box seat. Enterprise software firm ServiceNow shares bounced higher on a broker upgrade. Walmart, the world's largest retailer, also due to report earnings this week, which could offer a clearer picture of how US consumers are faring. Dominion Energy shares surged after power firm NextEra Energy said it would buy the utility in an all-stock deal valued at close to $67 billion. The shares of Regeneron tumbled as the drug maker's experimental treatment missed the main goal in a late-stage trial in patients with advanced melanoma. Well, President Trump has said he had paused a planned attack against Iran to allow for negotiations to take place on a deal to end the war in the Middle East after Iran sent a new proposal to Washington. President Trump said he had instructed the US military that we will not be doing the scheduled attack of Iran tomorrow, but have further instructed them to be prepared to go forward with a full, large-scale assault of Iran on a moment's notice in the event that an acceptable deal is not reached. Well, bond yields eased following those comments. However, the bond market is signalling that the war in Iran may deliver a lasting inflationary shock, with sovereign bond yields racing to decade highs and threatening a severe hit to the spending power of governments, businesses and households. Yields on longer dated US Treasury notes climbed to their highest in more than a year in overnight trade before easing. The 10-year yield climbing to 4.66%. The 2-year was at 4.06, having earlier climbed to 4.1%, its highest level in 14 months. Australian 3-year government bond yields fell to 4.68%. The 10-year was at 5.07. The US dollar index down slightly on the day, the Aussie trading at 71.7 US cents. And a quick check of commodities. Oil prices, they've climbed to a 2-week high as worries over supply disruption from the Iran war offset a report that the US had agreed to waive sanctions on Iranian crude during talks. Brent futures rising to $112 a barrel before easing to $109. That's following President Trump's comments. Gold edged higher, supported by a weaker US dollar. Copper futures rising slightly. Iron ore down to 110 a ton, and Bitcoin falling to 77,000 US dollars. All right, let's get across those market moves. Steve Sosnick is the Chief Market Strategist at Interactive Brokers. Steve, welcome back to you. So, look, a lot of focus on the bond market at the moment and essentially what that is signalling. What have you made of those moves?
Good morning, Andrew. The bond market has been sort of moving in the wrong direction for some time, and stocks have been able to largely ignore it. I think Friday's global bond sell-off was just too big for them to finally say, they could not ignore it anymore. What we saw over the past week was we saw on as early as Tuesday or Wednesday, we started seeing what 2-year notes flirt with a 4% yield and 30-year notes flirt with a 5% yield after the CPI report. Then on Wednesday, we had a 30-year auction, and it was the first time since 2007 that a 30-year auction priced over 5%. Nobody likes any comparisons to 2007, but yet we still pretty much ignored it Wednesday and Thursday. But then Friday's sell-off was just too big to ignore. I really did feel like there was a different character to the market because of the bond sell-offs. We got the 2-year well above 4%. We got the 10-year well above 4.5. and basically uh, went. There was very little dip buying activity on Friday. Today, I was expecting a bit more dip buying activity. It just didn't arrive.
What is this all telling us about what the Fed is likely to do? Of course, it comes at a critical time with Kevin Warsh about to assume the helm.
Well, I think part of this is that the Fed has been taken out of the equation. The higher than expected CPI numbers, and to a certain extent, the not very friendly PPI numbers on Wednesday, were just another shock. And clearly, the moves on Friday in bonds were related to this. We went from having a 2%, the certainty of two rate cuts before the end of the year, with a 50% chance of a third rate cut by December. That was what it looked like at the end of February. At this point today, we're looking at, call it a 65% chance for a rate cut, a rate hike, I'm sorry, by the end of this year, with a full rate hike priced in by March. That is extraordinarily different. And it's amazing to me that it actually took stocks this long to recognize it, but they've been so enamored with momentum that we find ourselves in this situation.
Steve, we're just breaking up there a little, but will persist. Let's take a look at what we saw in the equity markets. Now, we did see some profit taking, certainly among those tech stocks. We know how well they have done of recently, pushing both the Nasdaq and the S&P 500 to record after record. In this case, it was President Trump announcing that he's called off a planned strike on Iran. Interesting, Steve, I see you note that there's some interesting trading going on in regards to what the president is doing.
Yeah, this was in many cases, pretty much the big story here. I spent a good portion of the morning being asked about it by various market counterparts and other reporters. You could see there that the S&P 500 in the chart you're showing just started to tick down below its 10-day moving average. So it does show that the moves are in place. But getting back to the president's moves, there was a disclosure that he traded just under 3,700 times in the first quarter. Let that sink in for a second. 3,700 trades in a quarter. That averages out to about 58 trades a day. Okay? There is nobody who can have a full-time job, and let alone one as demanding as president, and have enough time to trade, call it 60 times a day. To be fair, that probably money to a high-frequency trading type of asset manager. If he does, so be it. He's entitled to do so. He has a blind trust for that reason. The problem is, though, some of the trades within the blind trust don't look so blind. There are some examples of him buying stocks before he met with certain executives. In the case of Dell, he bought Dell stock shortly before he then said publicly everybody should buy a Dell computer. So there's some stuff out there. The number of the trades bothers me less than sort of the explanations around it, and the small trades, I think, again, could be part of an algorithmic platform, but not some of the big ones, shall we say, very well timed. And this is a problem because we've seen more than a few well-timed prediction market trades, and especially crude oil trades. And with the exception of one Navy officer who was caught for or accused of insider trading ahead of the Maduro raid, we really haven't seen anything from this. And it does raise the questions when he says something like, we're calling off a bombing raid that really we weren't talking about anyway. You do have to wonder. It's easy to ask the question. I shouldn't say you have to wonder, but it's easy to ask the questions. Who's benefiting from this? Is this just benign, or is there more to it? And that's a very unfortunate situation for us to be in.
Well, indeed, no doubt that will prompt political scrutiny. What about scrutiny from the regulator? Is that likely?
No, because he controls the regulators. The CFTC, the CFTC is supposed to be a 5-person commission. It has one guy right now, literally one. The SEC is, the commissioner. There's 5 commissioners there, and the lead was appointed by the president. And he is very much, in many ways, a loyalist. It's hard to imagine him doing too much in that regard either. Uh, we could go on and on. There's plenty of there's no shortage of, shall we say, questionable examples out there. So I don't sense a lot of enforcement right now coming from the administration, basically.
Now, Steve, big event this week in Nvidia's results. How critical is this going to be for the market, given the momentum we've seen? Depending on whether, of course, it beats or misses, a miss would be a big story, wouldn't it?
Yeah. I doubt that they miss because realistically they're so good at guiding the street. But so the question then is, where is the whisper number and where is the hoped for guidance? Because I think that after the rally we've seen in chip stocks, after some of the excellent numbers we've seen in terms of earnings and guidance from some of the chip stocks, I think it's fair to think that maybe the street is looking a bit ahead of just the posted numbers. So it's not whether they beat or whether they guide well, it's how much do they beat the anticipated numbers. Another one, by the way, so that's Wednesday after the closeout time. Thursday before the open, we also get Walmart results, which I think is very important considering how terrible consumer sentiment has been. And fascinatingly, I think this is like a question I like to fool people with. Which has the higher PE, Walmart or Nvidia? And I won't embarrass you, but the number is actually, they're about the same. They're both about 49. The difference being that the forward PE for Walmart is about 45 and the forward PE for Nvidia is about 26, meaning that a lot more earnings, a lot better earnings are priced in for Nvidia in the coming year. But this combination is very important, and particularly because so much of this rally that we've been a part of has been driven by semis, which itself has been driven by ever increasing AI spending. No one is better positioned to tell us if that AI spending is continuing than Nvidia. So there's a lot to watch for.
There is indeed. Steve, great to get across those moves. Thanks for joining us from Interactive Brokers.
Thanks so much, Andrew. We'll talk again soon. Take care.
Let's turn to the local market then ahead of the open now. Bit of a reversal likely ahead, as you can see. S&P ASX 200 futures up almost 1.1%. So looking to regain those losses of yesterday with a rally ahead. We'll get right across that in just a moment. Stay with us for the open.